Good evening, students. So I hope you have revised till now. We have done the depreciation in the last class. Can somebody revise quickly for me in 5 minutes regarding what we have done in the last class? Yes.
Yes, ma'am. Section 28(5) interest remuneration, salary, bonus, commission to the partner from the firm.
Hmm.
Disallowed in the hands of the firm, not chargeable to tax under Section 40B. Profit from the partnership firm, however, it is exempted under Section 10(2)(a) to the partners. TDS under Section 194T at 10% over the payment credit of rupees 20,000. Then we have seen 28(6)(a), non-competence fees or amount received for not sharing know-how intangible assets. Does not include the transfer of rights of manufactured products, right to carry out business of profession as it is a capital gains. 28(6), sum received on key man insurance policy. If it is in a business of profession, then under Section 28(6), PGBP income. If it is received by employee, then under Section 17(3), it is salary. If it is by third person like family members, then it is income from other source under Section 56(2). Then Section 28(6)(a), conversion of stock in trade into capital asset. It is PGBP income as on fair market value as on the date of conversion plus cost. Fair market value as on date of conversion is prescribed in the rules. Stock in trade, if stock in trade is an immovable property, then stamp duty value of the immovable property, and if it is any other asset, then market value. When the capital asset is sold, capital gain will be for the capital gain, cost of asset will be the fair market value as on the date of acquisition. And if that asset is used for the purpose of the business profession, then the cost for the depreciation will be the fair market value as on the date of conversion. Then Section 29, computation, net profit as per the P&L or accounts. Then we will add back ICDS 1 to 10 and less anything from the ICDS as per the ICDS 1 to 10. Then add back disallowance of expenses under Section 30, 31, 36, 40. Then less expenses allowed. Add back any deemed income under Section 41 and less any income chargeable under any other head. Then we will be deriving the uh, income from PGBP. Then we have gone to Section 30, rent, rate, taxes, repair, insurance for building. Capital repairs are not allowed. Revenue repairs are allowed. Any expense, what is meant by capital repair is any expense which bring in new assets or gives an advantage of enduring nature. Then it is a capital nature and it has to be capitalized. It prolongs the life of an asset. If the expenses is incurring for the improving or smoothing the performance of the business, then it is of revenue nature. Revenue repairs. Or here we have seen the case laws, Oriental Ceramics and Industries Limited. Expenses for the glow sign boards, it is revenue in nature because no permanent asset is coming in, and moreover the glow sign boards get deteriorated due to the weather conditions. And these are installed for the facilitating of the businesses. So these are in revenue in nature. Priya Village Road Shows Limited, expenses for facilitating for the study of the under technical development, understanding the technical development, and it is discarded. Since it is discarded, no new asset has been come into the existence, so it is revenue in nature. Again, in Adhyayam Tech, expenses incurred in the software which is abandoned due to the technical upgrade, it is revenue expenditure because no new software, no new asset comes into the existence. Then Honda Silai Cars India Supreme Court, where technical fees has been given for technical collaboration, and new joint venture is they are forming the new joint venture. Since here they are forming the new business, so it will be in capital in nature, not in revenue in nature. Then we have seen Section 31, repair insurance of machinery, plant and furniture. Revenue nature repairs are allowed, capital repairs are not allowed. Then ICDS 5, tangible fixed assets. If expenses increases the future benefit existing assets beyond its previous performance, then we have to capitalize it. Then we have gone to Section 32, depreciation. tangible assets and intangible assets. For tangible assets, building except land, plant and machinery, furniture. Then the intangible assets, know-how, patents, copyrights, any other business commercial in same nature, other except goodwill. Goodwill is not an intangible asset. Then we have gone through plant definition under section 43(3), ships, vehicle, books, scientific apparatus, surgical equipments. Uh, Tea bushes and livestock are not plant and machineries. For claiming the depreciation, two important criteria have to be met. Asset should be he should be the owner of the asset. SSC should be the owner of the asset, and asset should be used for the purpose of business or profession. Uh, Even if the legal title is not transferred, even if SSC is the beneficial owner, depreciation allowed to the beneficial owner also. For example, vehicles and buses which on which the legal title has not been since transferred to the owner, then also the depreciation will be allowed. If roads are developed by the contractor and since the ownership rights are with the government, the SSC cannot claim the depreciation on them. Then CBDT circular for the hire purchases, if at the end of the period the lease lease end of the period of hire purchase, if the asset is transferred to the is transferred, then he can claim the depreciation. Explanation 1 to the section 32. If the SSC is the lessee and he has made any capital expenditure on the asset to bring out the structure or repair or extension, then lessee can claim the depreciation on that expenses. Asset used for asset used for the business or profession, it includes passive use also, kept ready for use also. For example, standby equipments, fire extinguishers. Example. Again, section 32(1), power generation or distribution companies. For power generation distribution companies, straight line method, it is an optional method. It has to be selected before the due date of filing of the return. And once it is opted, we cannot revert it back. If when the asset is destroyed or demolished, then if the sale consideration is less than the written down value, then whatever the difference amount is terminal depreciation, allowed as a terminal depreciation under section 32(1)(3). If the sale consideration is greater than written down value, here we will be having two cases. If sale consideration is maximum up to the actual cost, then the difference amount will be deemed income under section 41(2) as balancing charge. If the sale consideration is greater than that of the actual cost, then up to the actual cost, it will be the deemed income under section 41(2), and then above over that, it will be the capital gain under section 50A. Then we have gone through block of assets under section 43(6), section 43(6), open return down value. Open return down value as an 1/4. Add actual cost of the asset acquired during the previous year. In that, we will be segregating less than 180 and greater than 180. Then money receivable on asset discarded, sold, or demolished, including the scrap value. In case of lump sum, less. In case of lump sum, actual cost minus what you say depreciation allowed. Then we will be getting cost of the closing return down value. Then asset arrived during the previous year. If the asset is arrived during the acquired during the previous year, then return down value is equal to actual cost under section 43(1). To actual cost include cost to bring the asset into the existence, putting the asset into the working condition. Charlapalli Sugar Mills Supreme Court case. Then ICDS 5, actual cost is purchase price plus import duties, excluding the creditable taxes, direct expenses making asset ready for use, less trade discount, less rebates, add startup expenses like pre-production expenses, then add interest up to the put to use. Put to use, it should be capitalized as per the section 43(1) explanation 8, section 36(1)(3). In case of asset is used for scientific research, and then it brought to the PGBP, then the value of the asset will be nil. Since total depreciation has been claimed and 100% depreciation will be claimed under section 35. If stock is trade is converted into capital asset, then actual cost will be fair market value of the date of conversion as per 28/6. Capitalization, then we have gone through ICDS 9, capitalization of the interest. Uh, if the borrowing is for specified qualifying asset, then capitalize the borrowing cost, and we will start from the date of the borrowing and we will end till it is put to use. And if it is from the general borrowings, then we will use interest into average cost of the qualifying asset divided by average cost of the total asset, and we will start from where the funds were utilized till the asset was put to use.
Good, I
Then
think. Yeah. Thank you so much, Yogesh, for summarizing it really well. So let us start with it. I think what is left is now we have completed the ICDS. Okay, we have completed, if you look at it, ICDS 1, ICDS 2, ICDS 3. We not ICDS 3, we have not yet done. Then we have completed ICDS 4, which was revenue recognition. We have already done with ICDS 5, which is the tangible asset. We are done with ICDS 7, which is the government grant. We are done with ICDS 8 on securities. We are done with ICDS 9 on the borrowing cost, and ICDS 10 on the provisions. So if you look at it, we are only left with two ICDS by now, right? If you would have done ICDS, so one by one, you would have not been able to appreciate how to link it, right? So that's how we have completed it. Now we'll start with today ICDS 6. Okay. So what we were at basically 43.6 section, right? Which is the WD, right? We talked about for the assets acquired in the previous year, it is the actual cost. For the assets, there is like actual cost is cost to previous owner. We have seen some cases. Then actual cost is calculated on notional basis for some cases, like WDV on the notional basis. In some cases, we have seen that. Here I write WDV on notional basis, right? And here also you can just write actual cost or WDV is equal to the WDV or cost to the previous owner, right? Okay. Now we are going to move towards the next particular part, which is the section 43A. We are going to talk about the section 43A. Now, what is section 43A? Let us have a look into section 43A. Okay. So let us go to the Income Tax Act. Let us look at what does 43A talks about. Yes. Special provisions consequential to changes in the rate of exchange. What does it say? Notwithstanding anything contained in any other provisions of this act. Meaning what? It overrides the all other provisions of the act. Yes or no? Right? So it overrides all other provisions of the act. Where an assessee has acquired any asset in the previous year from a country outside India. So, for the applicability of 43A, what is important is that the asset is being acquired outside India. Right? The asset is being acquired from outside India. That is the first very condition. So, let us just write it over here. right? So what is it saying? Asset is acquired from outside India. This is the first condition, meaning it should be an imported asset. Fine, it should be an imported asset. Asset is acquired from outside India. For the purposes of his business and profession, and in consequence of the change in the rate of exchange during any previous year after the acquisition of that asset, there is increase or reduction in the liability of the assessee as expressed in Indian currency as compared to the liability existing at the time of acquisition of the asset. At the time of making the payment, at the time of making the payment towards the whole or part of the cost of the asset, or towards the repayment of the whole or part of the money borrowed by him from any person, directly or indirectly in any foreign currency, specifically for the purpose of acquiring the asset along with interest, if any. Right? The amount by which the liability as aforesaid is so increased or reduced during any previous year, and which is taken into account at the time of making the payment, irrespective of the method of accounting adopted by the assessee, shall be added to or deducted from the actual cost of the asset as defined in section 43(1). Are we getting this particular point? And the amount arrived at after such addition or deduction shall be taken to be the actual cost of asset, right? So what it is trying to say is that if you have acquired any asset from outside India, if you have acquired any asset from outside India, that is the first condition, and or we have taken a loan in foreign exchange to acquire the asset from outside India. Right? Because it is saying we have acquired the asset from outside India, or so at the time of making the payment for the cost of the asset or towards the repayment of money borrowed by him in any foreign currency, specifically for the purpose of acquiring the asset outside India. So, or borrowed money outside India for the purpose of acquiring asset outside India. So asset has to be an imported asset only. Will section 43A be applicable where, say, let's say for example, the loan is taken outside India but the asset is acquired within India? Yes?
No, ma'am.
Right? In that particular case, 43A will not apply. So 43A is applicable only in a situation where the asset is acquired from outside India. It is not applicable in a situation where the asset is acquired within India and the monies are borrowed from outside India. So 43A is not applicable if asset acquired in India through the external commercial borrowing. The word used under FEMA is external commercial borrowing, which means what? What is external commercial borrowing? Yes?
Borrowing money outside India.
Correct. Borrowing money outside India is nothing but the external commercial borrowing, which is called under the FEMA. Right? So under FEMA law, we say external commercial borrowing. That the money that we are borrowing from outside India. Fine. So any asset which is acquired outside India, only that is covered by 43A. So in that particular case, any exchange gain or loss shall be recognized not on the year end, students. It will not be recognized on year end, but only on the payment basis. This is very, very, very important. And this is irrespective of method of accounting. This is irrespective of the method of accounting. Right? So you have to remember this particular point. This is only on the payment basis. So let's say, for example, I have acquired the asset on 1st of June, let's say 2025, for let's say $10,000. Right? When the exchange rate was 1 USD is equal to rupees, let's say 80. Now I am making the payment in installments. I have not taken any loan. I am making the payment in installments. Let's say the first installment is due on 31st December, $5,000. Next installment will be due on 30th June 2026, $5,000. On this day, exchange rate was 85, right? And let's say on 31st March, the exchange rate is rupees 90. So how much we will recognize the exchange gain or loss?
Five
This
into
shall,
5,000.
correct. This shall be capitalized, not recognized. This shall be capitalized to the actual cost of the asset, right? So this 5, the difference between this into whatever is the dollar amount, which is 10,000. So this 5 into 10,000, oh sorry, 5 into 5,000, not sorry, 10,000, my mistake. Because only 5,000 is being made payment. So 5 into 5,000, which comes to 25,000. This shall be capitalized to the actual cost of the capital asset, right? And the balance amount will be capitalized in the next year. On year end, we will not give any effect. Yes, Geet. Are we clear about 43A? Fine. Yes or no? Any questions, any doubt? Is it clear, students?
Yes, clear.
Okay. So in this particular case, what you have to do is you have to capitalize to the cost of the asset. Clear? So any amount that you repay, that will be capitalized to the actual cost of the asset. Clear? Fine. Now, there is also a specific ICDS, which is there on the foreign exchange gain and loss. What is the ICDS? Let us look at it. So we have ICDS 6, effect of changes in the foreign exchange rate. So that is what we are also going to deal with now, which is ICDS 6.
If
Or
the dollar exchange rate reduces from 80 rupees to suppose 75 rupees, so that will be reduced from the actual cost of the asset, the difference?
correct. Yes, it will be reduced. Yes.
Okay, okay.
Right? Because the section, if you look at it, says very specifically shall be added to or deducted from the actual cost of the asset. Clear? Even the
It's clear.
interest portion that you are capitalizing, if you look at it, the amount of expenditure of a capital nature referred to in 3619, right? So that portion that you capitalize will also be affected by, because if you look at it, it says towards the repayment of whole or part of the money borrowed indirectly in any foreign currency, specifically for the purpose of acquiring the asset, along with the interest, if any. So whatever amount I'm capitalizing, let's say I have not put the asset to use. So interest amount will also be capitalized until I put the asset to use. So even that, any gain or loss on that will also get capitalized there. Are we clear? Yes or no?
Yes.
Fine?
मैम इंटरेस्ट
Yes.
अमाउंट पे जब हम लोग पेमेंट करेंगे कब भी रिकॉग्नाइज करेंगे ना मैम, कैपिटलाइज
Correct. Yes.
करेंगे.
Correct. Yes. It will be entirely on the payment basis. Fine. Now coming to this ICDS 6, which is there, what does it say? For foreign currency transaction, it talks about first the initial recognition. How do you initially recognize? It says a foreign currency transaction shall be recorded on initial recognition in the reporting currency. Reporting currency is our INR. By applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency at the date of the transaction. So reporting currency is what? Reporting currency means the Indian currency. Except for the foreign operations where it shall mean the currency of the country where the operations are carried out. Otherwise it is Indian currency. Now the foreign currency transaction shall be reported on the initial recognition in the reporting currency, which is INR, by applying the foreign currency rate to the exchange rate which is there on the date of the transaction. So first is initial recognition. So this will be recognized using the exchange rate on date of transaction. Fine. So what does it say? An average rate for a week or a month that approximates the actual rate at the date of transaction can also be used for all the transaction in each foreign currency occurring during that period. Right? If the exchange rate fluctuates significantly, the actual rate at the date of transaction shall be used. Now, as on the last day of the previous year, the foreign currency monetary items shall be converted into the reporting currency by applying the closing rate. What is the monetary item, students? What do we understand by monetary item?
Receivable in cash.
Yes, which can be converted into cash. So as on the last date of previous year, right? In case of the monetary item, right? What is a monetary item? The monetary items are the assets or your liabilities which are to be paid in the fixed amount of money, which can be converted into cash. Cash, receivables and payables are the monetary items. So basically my asset or liability, payable or receivable in fixed amount, which is receivables, payables or my cash, right? So the monetary item is to be converted as on the last day of the previous year by applying the closing rate, right? By applying the closing rate, which is the exchange rate as on the last day of the previous year. Next, for the non-monetary item, okay, before that it says where the closing rate is not reflecting the reasonable accuracy, then the amount is to be converted based on the amount likely to be realized or likely to be received. Because some countries have, let's say, restriction due to war. It is not possible to find out exactly the closing rate, right? So in that particular case, the amount which is likely to be realized. Now, for the non-monetary item, it shall be converted into the reporting currency by using the rate at the date of the transaction. So basically what it is trying to say is that only the monetary amounts which are there, this shall be converted into the closing date, the rate as on the closing date. Whereas the non-monetary item which are there you will not convert them into the as on the closing rate. So only in respect of the monetary items which are there, you will convert as on the rate, to be converted into rate as on the closing date. So here you will recognize mark to market gains or losses, right? The conversion difference which is there, obviously, where will you book? You will not capitalize. You will take it to the P&L. As far as the non-monetary item is concerned, so what will be my non-monetary example? Fixed assets, investment, right? These are my non-monetary. Recognize as per rate on the date of the transaction itself. Therefore, M2M, mark to market gain or losses, are not recognized. Mark to market gain or losses are not recognized. Are we clear? Yes or no, students?
Clear, ma'am.
Clear? Now, in respect of the non-monetary items, therefore, you will not recognize the gain or loss to the P&L, or you will not at all recognize itself any foreign exchange gain or losses. There is only one exception to this. What is the exception? Yes. There's only one exception to this. Geet, unrealized revenue gain or losses are allowed as deduction for monetary item, not for non-monetary item. For non-monetary, we will not recognize the exchange gain or loss as on the year-end date. Right? We will only recognize as on the
Inventory,
date of... Sorry?
inventory.
Inventory, but for the non-monetary item, the exception is section 43A. So as on the date of payment, you will recognize the exchange gain or loss and will capitalize to the cost of asset. Are we clear? As far as now, let us go back here. It says non-monetary item being the inventory, which is carried at the net realizable value denominated in foreign currency, shall be reported using the exchange rate that existed when such value was determined. So even for the inventory, you will not recognize the value. You will not convert it to the value as on the closing date. You will, in case the inventory is valued at NRV, you will recognize using the exchange rate that was as on the date when the NRV was determined. Right? So here you can write down for inventory, valued at NRV. If inventory is valued at cost, then of course it will be the exchange rate as on the date of transaction itself. Okay. In respect of monetary item, exchange differences arising on the settlement or on the conversion as on the last day of previous year shall be recognized as income or expense in that previous year. So as I said, in respect of monetary item, you will recognize the exchange gain or losses to the P&L, either on the settlement or on conversion on the last day of previous year. In respect of non-monetary items, exchange differences arising on the conversion shall not be recognized as income or expense in that previous year. So any closing date, the M2M gain or losses, you will not recognize. Notwithstanding anything contained in 3, 4 and 5, initial recognition, conversion and recognition of exchange difference shall be subject to the provisions of 43A as the case may be, right? So as I said, 43A is an exception to this. Are we clear? Then forward exchange contract, any premium or discount arising on the forward exchange contract shall be amortized as an expense or income over the life of the contract. Are we clear? So just write down for the forward exchange contract. Amortize over the life of the contract. Are we clear? In case the forward exchange contracts which are there are intended for trading or speculation purpose or are entered to establish the amount of reporting currency that shall be available at the settlement date of the transaction, or it is entered into to hedge the foreign currency risk which is there. So in that particular case, in case it is for hedging, the provision of para 1 will not apply. In case it is for speculation or trading, in that particular case, whether para 1 will apply, the answer is no. So the particular amortization of the premium or discount over the life of the contract is applicable only when it is not intended for trading or speculation purpose, or it is not entered for the hedging. So the premium, discount, exchange differences on the forward exchange contract that are intended for speculation, that are intended into for hedging, shall be recognized at the time of the settlement. Are we clear? So let's just write down. Forward exchange contract, for speculation or hedging, recognize on settlement. So exchange gain or losses shall be recognized on settlement. Is ICDS 6 clear to everyone? Any questions, any doubt? Yes?
Ma'am, forward
Yes.
exchange contract for trading purposes amortize over the contract life of the contract.
No. For trading, speculation, hedging, for 3 purposes, it will be recognized on the settlement. Here it will also include the trading.
Okay.
Other than that, any forward exchange contract, you have to amortize the premium or discount over the life of the contract.
Okay.
Clear? Any other questions? Any doubt?
सेक्शन 43A का जब डेट ऑफ पेमेंट करेंगे तब भी हम लोग रिकॉग्नाइज करेंगे एक्सचेंज रेट
Yes.
लिंक, राइट?
Yes.
ओके.
Okay. So this completes your ICDS 6. Fine. So see, we have done the ICDS 6 also. Now we are only left with ICDS 3, which we will do in the last lecture on the PGBP that we have. Okay. Now going back to where we had started, which was section 43. So we have done the actual cost, meaning of the actual cost we have done, right? We have done all of these explanations which are there, right? We have also seen under 43 what is the written down value in case of different assets, right? Now, in case of this 43, right, we have completed that particular aspect as well completely, right? So now what we are required to do is, now we are required to go back to 32, which was depreciation. Now what is left under the depreciation is the topic on the additional depreciation. So let us look at it. Additional depreciation is given under 32.1. Yes. What is the depreciation schedule?
32.128.
Correct. Clause 32.128, which says in case of any new machinery or plant other than ships and aircraft which has been acquired and installed by an assessee engaged in the business of manufacture or production of any article or thing, or in the business of generation, transmission, distribution of power. So, who is the eligible assessee for additional depreciation? Engaged in manufacturing or the production, generation, transmission, or distribution of power. Right? Generation, transmission, or distribution of power. What is my eligible asset?
New assets purchased.
New plant and machinery. This is very important. This is not on any other asset other than ship or the aircraft. Right? Then this particular additional depreciation shall be allowed in respect of any plant or machinery which was, sorry, this additional depreciation shall not be allowed in respect of any plant or machinery which before its installation was used within or outside India by any other person. What does this mean? On second-hand plant and machinery, we will not allow the additional depreciation. On second-hand plant and machinery, we will not allow the additional depreciation. So, what is my ineligible asset? Second-hand plant and machinery, even if it is imported. Right? Any plant or machinery installed in the office premises or any residential accommodation including the accommodation in the nature of guest house. So, residential accommodation or office premises. Any plant or machinery which is in the nature of any office appliance or road transport vehicle. So any office appliances or road transport vehicle are not eligible. Any machinery, the whole of the actual cost of which is already allowed as a deduction in computing the income chargeable under PGBP of any one previous year. So, which has already been allowed as deduction, for example, scientific research, 3580, on those we will not get additional depreciation. Fine. So, what is the additional depreciation? It is a sum equal to 20% of the actual cost of such machinery shall be allowed as a deduction. Are we clear? So what is the additional depreciation which is allowed? 20% of the actual cost. Are we clear? So this is the additional depreciation which is allowed to the assessee. Now, if you look at it, it says where an asset referred to in, where the asset which is referred to in the clause 1 or clause 2 or clause 2A or the first proviso to clause 2A, as the case may be, is acquired by assessee during the previous year and is put to use for the business or profession for a period of less than 180 days, then the deduction shall be restricted to how much? 50% of the depreciation which is prescribed under the Act. Are we clear? So the deduction which is there is restricted to 50% if the assets are put to use for less than 180 days. In case where an asset is referred to in clause 2A, which is on which the additional depreciation is allowed, is acquired by the assessee during the previous year and is put to use for the period of less than 180 days, and the deduction is restricted to 50% of the depreciation. 50% of the depreciation, which is the additional depreciation. Then the deduction for the balance 50% of the additional depreciation, which is referred to in 2A, shall be allowed in the immediately succeeding previous year in respect of such asset. Are we clear, students? Yes or no? So what does this mean? That if asset is put to use, or let's say I'll write plant and machinery is put to use for less than 180 days, then additional depreciation restricted to 10%, right? So therefore the balance 10% is allowed in the next previous year. Are we clear, students? Fine. Any questions with respect to additional depreciation?
Clear, ma'am.
Fine. Okay. So this is about your additional depreciation which is there.
This additional, the next year we get the depreciation allowance 50% is allowed also on the normal depreciation?
No,
Or is it
that is
only on
only
the
for
additional?
additional depreciation.
Okay.
Yes. Only for the asset under clause 2A, which is the additional depreciation. Now, this is one very important proviso which is mentioned over here. It says that the aggregate deduction in respect of depreciation of building, machinery, plant, furniture, tangible assets, or in respect of the intangible assets allowable to the predecessor and the successor in the case of succession and in the case of transfer of the capital asset by a holding company to the subsidiary company, or in the case of the succession of the proprietorship or the LLP to a company or partnership to a company, or to the amalgamating company and the amalgamated company in the case of amalgamation, or to the demerged company and the resulting company in the case of demerger, shall not exceed in previous year the deduction calculated at the prescribed rates as if the succession, amalgamation or demerger had not taken place, and the deduction shall be apportioned between the predecessor and the successor, or the amalgamating company and the amalgamated company, or the demerged company and the resulting company, in the ratio of the number of days for which the assets were used by them. Now, what does this imply, students? This is basically implying that the depreciation which is there in the case of amalgamation, in the case of demerger, in the case of conversion of sole proprietary into company or conversion of company to the LLP, the depreciation shall be proportionally apportioned between the predecessor and the successor in the number of days. So just write down over here. In the case of, or you can write here, proportional depreciation. In the case of succession, conversion of proprietary concern or firm to the company, conversion of company to LLP, amalgamation, demerger, depreciation to be allocated to predecessor and successor in the number of days asset used by them. Right? In the number of days the asset is used by them. So the depreciation will be allocated between the predecessor and the successor. So first you will calculate the depreciation normally and then you will allocate between the two companies in the number of days the asset is used by them. Is this clear, students?
मैम अभी एक सोल प्रोप्राइटर है मैम, वो पहले सपोज 6 to 7 months एक बिजनेस कर रहा था, ठीक है। आफ्टर 7 months वो बिजनेस क्लोज कर दिया, उसमें जो एसेट्स है उसने दूसरे बिजनेस चालू किया, उसमें ट्रांसफर कर दिया, तो उसमें भी प्रोपोर्शनेट बेसिस में डेप्रिसिएशन
Correct.
लेंगे।
It's a succession of business.
सक्सेशन,
Yeah. So if it's a
सेम
succession of
प्रोप्राइटर।
business, yes. See, if my business is succeeded by some other person, so in that particular case, I will allocate the depreciation between the two based on the number of days that the asset have been used by them.
सम अदर पर्सन है मैम, प्रोप्राइटर वही था। सपोज मिस्टर एक्स है, वो कोई धंधा कर रहा था, उस बिजनेस को बंद कर दिया और फिर दूसरा बिजनेस चालू किया, सेम प्रोप्राइटर।
Okay.
तो सेकंड बिजनेस सेम एसेट जो पहले बिजनेस कर रहा था वो एसेट है ना, नहीं सेकंड बिजनेस में भी ट्रांसफर कर दिया, तो उसमें भी प्रोपोर्शनेट बेसिस में आएगा।
See, then it is not a case of succession. See, what does succession imply is succession means where, let's say, a person is carrying on the business and this is succeeded by another person who will continues to carry on the business of the predecessor. That is the case of the succession. Here, this is not the case of succession. Here, this is a case of closure of business. So, first, there will be the depreciation which will be given to them based on the block of asset concept. There will not be proportionate number of days in that case. In the case of the first business, then once you go to the other business, then in that particular case, these will be considered as the purchased asset. But for that purpose, your WDV will be the WDV which has been already taken because you have introduced the asset. So the notional depreciation will be allowed into that business, right? So in that particular case, you will start with that point and then you will allow the depreciation in this particular case in the other
Okay.
business. Yeah.
Okay. Thank you.
Okay. Fine. Any other question? So this is about the succession of the business and the proportional depreciation or proportionate depreciation which is allowed in this particular case. So remember this particular point that the depreciation which is there is to be allocated between the two businesses or sorry, between the two assessees based on the number of days the asset has been used. Now, with respect to the rates of the depreciation, we'll have a look at your module also. So these are the rates of depreciation which are there. So buildings which are used mainly for residential purposes except hotels, it's 5%. Buildings which are used for commercial purposes is 10%, right? Then you have some other depreciation rate. Furniture and fittings, it is 10%. Plant and machinery, if you look at it, motor cars which are there, it is 15%. Then aeroplanes, aero engines, 40%. Other plant and machinery, it is 15%, right? Then computers, it is 40%, right? So these are some of the rates of the depreciation. Intangibles, it is 25%. Goodwill is not a depreciable asset. Mobile phones and EPPX are not computers. Hence, they are not eligible for 40% rate of depreciation. They will be subject to 10%, while the UPS, printers, scanners are considered as computers and they will be eligible for the depreciation of the 40%, which is applicable to the computers itself. Are we clear, students? Any question with respect to this? Any doubt? Any question if you have? Fine. So just remember this particular point that the mobile phones are there or the EPBX are there, these are not considered as the computers.
So what would be the depreciation rate for mobile phones and
10%
EPABX? Oh,
for the
okay.
furniture. Yeah. UPS, printers, these will be eligible for 40%. Clear? Any other question, any doubt? Fine. Okay, let me see if we can do one question on the allocation of this depreciation. One second. So at least I can show you how we will do this. From your module itself, let me see if we can have one sum. So I'll request you to go through these questions in your module itself so that you will have a practice. Yeah. See, depreciation in the case of succession. Yeah, there is this one question. Sign Limited has a block of assets carrying 15% rate of depreciation whose WDV as on 31st March after reducing the depreciation for previous year 24-25 was rupees 40 lakh. It purchased another asset of the same block on 1/11/25 for 14.40 lakh and put to use on the same day. Sign was amalgamated with Sherry with effect from 1st January 2026. You're required to compute the depreciation allowable to SAI and Shirdi for the previous year 31st March 26, assuming that the assets were transferred were for 60 lakh. Also assume that the plant and machinery were purchased by way of account paid check, because if it is purchased for cash, it will not be considered as the capital asset, because you will reduce the amount from the actual cost, the amount paid in cash for acquiring the plant and machinery. Yes. So here, if you look at it, first it is opening WDV that they have considered. So what is the opening WDV? Was 40 lakh, right? As on 31st March 25 after reducing the depreciation for previous year 24-25. Now it purchased another asset which is second hand plant and machinery of the same block on 1/11/25 for 14.40 lakh and has put to use on the same day. So what will be the rate of depreciation, students?
7.5%.
Correct. 50% will be
1.5%.
allowed as it is less than 180 days you put to use. So 14.45 lakh, 4 lakh, 7.5%. On 40 lakh, which is the WDV, you will allow 15%, right? So we have made this addition and we are reducing this WDV, depreciation. So total depreciation is 7 lakh 8,000. Now the amalgamation has done on 1st January 2026. So until the 31st December 2025, SAI will be eligible for depreciation. After that, Shirdi will be applicable. So on 7 lakh 8,000 which is there, right? You will allocate this between the two entities. But you will not allocate directly 7 lakh 8 because this is comprising of two assets. So on first 6 lakh, you will allocate for 275 days, divide by 365 days to SAI and for balance days to Shirdi. On this 1 lakh 8,000, since this is purchased on 1st November. So this will be done for November and for December for 2 months, right? So which is allocated for 61 days divided by the total asset which is used for from November to March 151 days. So basis that you will allocate the depreciation between the two. So first you will calculate the depreciation as if the amalgamation had not taken place and then you will allocate between the two based on the number of days the asset has been used. Is this clear, students? Any question, any doubt? Fine? Yes or no? Is
Clear,
It's
ma'am.
depreciation
clear.
entirely
Clear.
clear to everyone? Yes? So we have seen how do you calculate the depreciation. We have seen how do you calculate your WDV. Now, after this amalgamation or demerger or succession take place, then in that particular case, for the successor, the WDV or the actual cost of the asset acquired during the year will be what? The cost to the previous owner. Are we clear? So in the case of amalgamated company, in the case of successing LLP, in the case of demerger, the resulting company, the WDV shall be the WDV in the hands of the amalgamated or demerged company. Are we clear? Now, one another important point which is left out under section 32, which is what we have to see. Let me open up the 32 again. What does this section says? Where in the case of assessment of the assessee, full effect cannot be given to any allowance under subsection 1 in previous year. What does this mean? Can anybody tell me what does this exactly mean?
uh, पूरा depreciation ले नहीं पाया because subsection 1
Correct.
intangible or tangible assets है, and he
Correct.
is not able to take entire depreciation.
Correct. Yes, Geet, correct. So, in case where the assessee has not been able to claim the depreciation entirely because the profits are less, owing to there being no profit or gains chargeable for that previous year, or owing to the profit or gains being less than the depreciation allowance, then subject to the provisions of subsection 2 of 72, which is basically the set off and carry forward of the PGBP laws, or section 73, which is the set off and carry forward of the specified business loss, then the allowance of the depreciation which has not been given effect to, which is called as unabsorbed depreciation, shall be added to the amount of allowance for the depreciation for the following previous year and deemed to be part of that allowance, or if there is no allowance for that year, like if there's no depreciation for the next year, be deemed to be the allowance for that previous year, and so on for the succeeding previous year. So what it is trying to say is, if there is the unabsorbed depreciation, right, then subject to section 72 and section 73, it shall be deemed to be the depreciation of next previous year and shall be carried forward indefinitely. So what does this mean? That in case the order of your set off shall be, first the current year depreciation, then the business loss or the specified business loss, and third will be your unabsorbed depreciation. Or let's say we can write brought forward unabsorbed depreciation. Because this is logical also, business loss has a time limit of 8 years. However, depreciation can be carried forward indefinitely. So first you will set off from the current year profits, the current year depreciation, any balance losses, business losses which are brought forward, or the specified business losses in case it's a specified business, and then the unabsorbed depreciation of the last year. Because this is subject to 72 and 73. And this unabsorbed depreciation shall be deemed to be the depreciation of the next previous year and shall be carried forward indefinitely. Are we clear, students?
Clear, ma'am.
Yes. Okay. Now the last point in the depreciation. Let us go back to our WDV under 43.6. Right? First we saw for the assets acquired in the previous year. Then we saw WDV, which is cost to the previous owner, or WDV to the previous owner, and WDV or the actual cost on the notional basis. Now, last one case where WDV shall be nil. If the block cease to exist, if the block cease to exist, or the sale consideration is greater than the WDV. If the block cease to exist, all the assets in the block are sold off, or if your sale consideration is greater than WDV, in that case the WDV shall be considered as nil and there will be capital gain under section 50 of the Income Tax Act. Let us look at section 50. What does 50 says? Special provision for the computation of capital gain in the case of depreciable asset. So, notwithstanding anything contained in 242A, 242A is period of holding, where the capital asset is an asset forming part of the block of asset, meaning it's a block of asset, in respect of which depreciation has been allowed under this act. Then the provisions of 48 and 49 shall subject to the following modifications will be the full value of consideration which is received or accruing as a result of transfer of the asset together with the full value of consideration received or accruing as a transfer of any other capital asset falling within the block of assets exceeds the aggregate of the following: exceeds the expenditure incurred in connection with the transfer, written down value of the asset at on the beginning of the year, or the actual cost of any asset acquired during the previous year. Such excess shall be deemed to be the capital gain arising from the transfer of short-term capital asset. So basically, this will be regarded as short-term capital gain under section 50 of the Income Tax Act. Are we clear? Or where any block of assets ceases to exist for the reason that all the assets in the block are transferred during the year, the cost of acquisition shall be the written down value of the asset as on the beginning of the year as increased by the actual cost of assets which are acquired by the assessee during the previous year, and the income received on transfer of such asset shall be deemed to be the capital gain arising from the transfer of short-term capital asset. Are we clear? Yes or no? So this completes your depreciation topic in entirety. If you have any questions, please feel free to ask.
मैम अगर लॉस होगा तो भी शॉर्ट टर्म कैपिटल लॉस ही होगा ना मैम?
Yes, if there is a loss, there will be short-term capital loss. So either there will be STCG in this particular case, or in case of this, where the block ceases to exist, here it can be the short-term capital loss. Fine. Okay, so this finishes our depreciation in entirety. Okay, so shall we take a break here for 10 minutes and then we start with the disallowances? Let's take a break here for 10 minutes. Okay. Start with the next topic, which is the deductions. Let's just, or disallowances, right? And deductions. So first we'll start with section 36. Okay, so from 32, I'm not going into 33 and all of those sections because that we'll deal in the next class. That is based on different sectors. First, we'll get into section 36. Okay, now I'll divide section 36 for your remembrance purposes into different segments. Fine, I'm not going to deal like section 36.1 is this, section 36.2 is this. Like, I'm not going to deal in that manner. I will divide it into three segments: employment related, finance related, and others. These will be my three parts which I will allocate it. Right? So first is the employment related is what we will start with it. So I'm dividing into first different buckets. Employment related. Second one is finance related, and the third one is my others. Okay, so let us start with it. First is the section 36.1 provides the deduction for in the following clauses shall be allowed in respect of the matters with dealt with therein in computing the income referred to in section 28. First is the amount of premium paid in respect of insurance against the risk of damage or destruction of stocks or stores used for the purposes of business or profession. So this is basically saying what? Any insurance premium paid in respect of the stock shall be allowed as the deduction. So I'll put it in others. Insurance premium which is paid in respect of the stocks. Stock is not your stock market wala stock, okay? Stock in trade. Okay? So this will be allowed as deduction. One is saying the amount of any premium paid by a federal milk cooperative society to keep or effect in force an insurance on the life of a cattle owned by the member of cooperative society, being a primary society engaged in supplying milk raised by its members to such federal milk cooperative society. So basically, this is saying for cooperative society, 1B is for the cooperative society or federal milk cooperative society, we can write, for the insurance premium for cattle. Okay. Next is any premium paid by any mode of payment other than the cash by the assessee as an employer to effect or keep in force an insurance on the health of his employees under a scheme framed in this behalf by the General Insurance Corporation or any other insurer approved by the IRDA. So basically what it is trying to say, that if the employer pays for the premium to ensure the health of his employees other than in cash, then that shall be allowed as a deduction to the employer. So this I'll put it in the employment related. 36.1 IB. Health insurance for the employees paid by the employer. This should be other than in cash. Clear? Next is any sum paid to an employee as a bonus or commission for services rendered, where such sum would not have been payable to him as profits or dividend if it had not been paid as bonus or commission. So what essentially it is trying to say that any bonus or commission paid to the employees for services rendered other than in the nature of profits or dividend shall be allowed as deduction under section 36(1)(2). Okay. Bonus or commission. It should not be in the nature of dividend or profit. Otherwise, what the companies will start doing is they will distribute bonus or commission because you will get the deduction of the bonus, but you don't get the deduction of the distribution of profit or dividend. Right? You don't get the deduction of dividend. So instead of giving the dividend to the employees who are also the shareholders, they will start giving the bonus or commission. So shareholders can also be employees, right? They will start issuing them the bonus or commission. So it should not be in the nature of profit or dividend. So bonus or commission to employees is allowed as the deduction. Now, there is one more important aspect which we are going to simultaneously look into, which is section 43B. What is section 43B saying? Let us look into payment basis, Geet. Yes, that's correct. Deductions to be allowed on the actual payment. It says notwithstanding anything contained in any other provision of this act, meaning 43B overrides all other provision of the act. A deduction otherwise allowable under this act, a deduction which is allowable under this act in respect of any sum referred to in 36(1)(2). What was 36(1)(2), students?
Bonus commission to the employees, not in the nature of dividend or
Correct.
profit.
Correct. So it is saying notwithstanding anything in any other provision of act, meaning 43B is saying I am overriding 36 also. A deduction which is otherwise allowable in respect of bonus or commission to the employees shall be allowed irrespective of the previous year in which the liability to pay such sum was incurred according to the method of accounting employed by the assessee, only in computing the income referred to in section 28 of that previous year. It shall be allowed in that previous year in which the sum is actually paid by him. So what does 43B say? I am overriding what 36 is saying, irrespective of whatever method of accounting assessee is following. Because 28 says the profit and gains as per commercial principles of accounting. Now, whatever method you follow, I am overriding every other provision. I am overriding 36, which gives you the deduction of bonus or commission. This shall be allowed only when you make the payment in that year. Shall be allowed in the previous year in which the sum is actually paid by him. Are we clear? So it says provided nothing contained in this section, nothing contained in 43B shall apply in relation to any sum which is actually paid by the assessee when it should be paid on or before the due date of furnishing the return of income under 139(1). In respect of the previous year in which the liability to pay was incurred. So this is going to be therefore subject to 43B. So 36(1)(2) deduction is what? Subject to section 43B, which means allowed if paid before due date under section 139(1). See, this is how you have to correspondingly read. Now, if you read 36 now, 43B later, you will forget what you were discussing, or you will forget any adjustment that you have to make in the examination. In examination, you will give the deduction of the bonus or commission. But let's say if you have not paid before the due date of 139.1, then the deduction will not be allowed. Are we getting this particular point? Yes? So you have to link and study, students. You can't be studying in isolation. One more important point, which I am going to discuss now. Section 40A2. 40A2 is what? 40A2 is where the assessee incurs any expenditure in respect of which payment has been or is to be made to any person referred to in clause B of this subsection. So there are these specified persons which are given. So where the expenditure is paid or incurred for any specified person, and the AO is of opinion that such expenditure is excessive or unreasonable having regard to the fair market value of the goods, services or facility for which the payment is being made, or the legitimate needs of the business or profession of the assessee, or the benefit derived by or accruing to him therefrom, then so much of the expenditure as is considered to be excessive or unreasonable shall not be allowed as deduction. So 40A2 says what? That if the expenditure which is being paid to any specified person and that expenditure is excessive or was not required to be incurred at all, looking at the needs of the business, or there is no benefit derived by incurring that expenditure. Let's say, for example, I have paid the salary to an employee, but he is not rendering me any service. Or I was not, at the first place, I was not requiring an employee to perform this service. Then, any excessive expenditure having regard to the fair market value will be disallowed by the AO. It is not to be suo motu disallowed if it is initiated if the AO thinks so. So, this can be subject to even 40A2. If employee is a related party. So what are the related parties here given? Where the assessee is an individual, any relative of the assessee. Are we getting it? Now relative here is defined here. Relative is defined over here. Relative, basically here it means that any person who is like, spouse, husband, spouse, parents, whatever, those are the relatives which are there. Where the assessee is a company, firm, AOP, HUF, any director of the company, any partner of the partnership firm or LLP, any member of the AOP, or the family member or relative of the director, partner or member. That is the person which is to whom if you make the payment, 40A2 will get attracted. Any individual who has substantial interest in the business or profession of the assessee, or any relative of such individual. Okay. So if any person has a substantial interest in my business, in the assessee's business, right? And when he has a substantial interest or any relative of such individual is also a related person. Are we clear? So not only the assessee's relative, but if any person has a substantial interest in that assessee or any relative of that person who has the substantial interest in that assessee, any payment which is being made to them will also be subject to this 43 or 48. Are we clear? Then a company, firm, AOP, HUF having a substantial interest in the business or profession of the assessee. not only an individual, but even any company, any partnership firm having the interest in the assessee, that is also covered. Right? So for individual, any relative of the individual, any person who is carrying on the business, if the person has a substantial interest in the business of that person, or any relative of that person who has the substantial interest. What do we mean by substantial interest over here? Substantial interest here means a person shall be deemed to have a substantial interest if in the case of business or profession is carried on by a company at any time the beneficial owner of the equity shares carrying not less than 20% of the voting power. Right? If you look at here, it says, for the purposes of this subsection, a person shall be deemed to have a substantial interest in the business or profession if, in case where the business or profession is carried on by a company, the beneficial owner of the shares carries not less than 20% of the voting power. In any other case, such person is at any time during the previous year beneficially entitled to not less than 20% of the profits of such business or profession. Okay. Now, if a company, firm, AOP, HUF has a substantial interest in the business of any assessee or any director, partner or member of such company, firm, AOP or any relative of such director, partner or member or any other company which is carrying on business or profession in which the first mentioned company has substantial interest. So what it is trying to say is, let us understand. If you look at section 40A2 like this, let me open in the next page itself. Okay. So, okay, what does it say? If the payment or not payment, if the expenditure is incurred for which payment is made to specified person, right? And the expenditure is greater than the fair market value, right? Is excessive or unreasonable having regard to the fair market value, or expenditure is not legitimate, or no benefit is derived from such expense, then the AO shall not allow the deduction as is excessive. In that case, excessive expense is disallowed. Right? This is if in opinion of the AO. So first case, who is a specified person? For an individual, his relative. For an individual, it will be relative. Relative means spouse, brother, sister, lineal ascendant or descendant. What the definition of relative is given under 241. Spouse, sibling, lineal, ascendant or descendant. Okay. Secondly, for the individual who is carrying on business or profession. So in respect of the individual carrying on the business or profession who has a substantial interest in the business of the assessee or any relative of the individual. So individual carrying on business or profession having substantial, which is greater than 20% interest in the business of assessee or his relative. So example of this could be, let's say Mr. A is there. He has interest of more than 20% in ABC. Or wife of Mr. A having greater than 20%. This is the second scenario, right? Where the SSC is a company, firm, AOP, HUF, right? In the case of company, AOP, HUF, firm, the director or his relatives, right? Director or the relatives of such director or partner, right? Or member or their relatives. Next is a company, firm, AOP having a substantial interest in the business of assessee. So company, AOP, HUF, firm having substantial interest, which is again greater than equal to 20% in the business or profession of assessee or their directors or partner or the member, right? If they have the substantial interest or their relatives. So let's say, for example, this is a ABC Private Limited. Let's say X Limited has the more than 20%, right? Or the director of X has more than 20%, or the wife of X has more than 20%. So in case the expenditure paid to any of them will be disallowed if it is excess, or any other company carrying on the business or profession in which the first mentioned company has substantial interest. Let's say, for example, second scenario will be any other company in which this company has substantial interest, right? So basically, what does it mean? Let's say, for example, if Y Limited is held by X Limited, right? This is, let's say, a wholly owned subsidiary. Now, if Y Limited deals with ABC, then in that particular case also this will be attracted. Clear? A company, firm, AOP, HUF of which a director, partner or a member, as the case may be, has a substantial interest in the business or profession of the assessee. Right? So any company, firm, AOP, HUF, either when it has a substantial interest or their partners, director or member have the substantial interest. Or even if they don't have the substantial interest, still they will be falling under this. So having substantial interest or even if they don't have. And the relatives of these partner, member or director. Right? So company, firm, AOP or HUF of which a director, partner, member as the case may be has substantial interest in the business or any director, partner or member of such company, firm, AOP or any other relative of such director, partner, member. So basically here what they try to say is in the fourth instance for the director, partner or member of a company, and these have substantial interest, right? So the other directors of this company or the relative of these director. So basically what they are trying to say is, let's say for example, if Mr. A is a director of ABC Limited, right? Now he has a substantial interest in XYZ. So this ABC Limited, if XYZ makes the payment to ABC, this is also attracted to 48. Or let's say Mr. Q is there, who is another director. So if he has any transaction with XYZ, this will also be subject to 48. Or any relative of Q, let's say Mrs. Q, this also will be covered as per this clause. Are we clear? Any person who carries on a business or profession where the assessee, which is an individual or relative of such assessee, has a substantial interest in the business or profession of that person. So if individual has any holding, is a substantial interest in another assessee, that is covered. Where the assessee is a firm, AOP, HUF, or director of such company, AOP or HUF, or any relative has a substantial interest in the business of the other person. So in these cases, 40A2 gets attracted. Are we clear about 40A2? Yes? Any questions, any doubt? Fine. So
Clear, ma'am.
40A says what? The provisions of this section shall have effect notwithstanding anything to the contrary. Meaning again, they will override any contrary contained in any other provisions of the Act. So these are the expenses which are not deductible. Clear? Now going back to my 36. So therefore, if the payment is made to an employee who is a related party, this will be subject to 48. Clear? So see, we are simultaneously doing too many provisions together, and this is how it has to be done, not in isolation. Clear? Let's go back to 36. Thirty-six 1(3). Amount of interest paid in respect of the capital borrowed for the purpose of business or profession. Provided that any amount of interest paid in respect of capital borrowed for acquisition, whether capitalized in the books or not, for the period beginning from the date on which capital was borrowed for acquisition of the asset till the date on which asset was first put to use, shall not be allowed as deduction. What does this mean? Yes, we have already done this.
We have to capitalize the borrowing cost until the put to use.
Correct. So interest is allowed as deduction, right? Interest is allowed as deduction. However, in case of asset till asset put to use, this shall be capitalized. Right? So this was also there in the explanation 8. Right? In case of loan borrowed for the capital asset, you can write like this here. Loan for the capital asset. Okay. Till the date asset is put to use, it shall be capitalized. Fine. Okay. So this we have already done, and this is also in line with the explanation 8 and your ICDS 9. Explanation 8 to section 43(1). Fine. So we are making a cross reference here. Prorata amount of discount on the zero coupon bond having regard to the period of life of such bond calculated in the prescribed manner. So 3A is discount on zero coupon bond. This is to be amortized over the life of bond. Fine. So this is fairly simple. No explanation needed here. Any sum paid by an assessee as an employer by way of contribution towards a recognized provident fund or an approved superannuation fund, subject to the limits as may be prescribed for the purpose of recognizing the provident fund or the superannuation fund as the case may be, and subject to the conditions as the board may think fit to specify in these cases, where the contributions are not in the nature of annual contribution of fixed amount. Right? So this is basically 3614. Employer contribution to the PF or the superannuation fund. Right? Employer contribution to the PF or superannuation fund. Again, students, this will be subject to section 43B. Very good, Geet. So, what does 43B again says? Let me open it here instead of going here and there. Let us see here. Any sum payable by the assessee as an employer by way of contribution to the PF or superannuation fund or gratuity fund or any other fund for the welfare of the employees. So a deduction otherwise allowable in respect of this sum shall be allowed only in the year in which the sum is actually paid by him. So this is also subject to section 43B. So if the employer has contributed to the PF and has not deposited before the due date of return under 139(1), this will not be allowed as deduction. Are we clear, students? Next section here to which it will be subject to is section 40A9. What is 40A? Disallowances. What is 40A9 saying? No deduction shall be allowed in respect of any sum paid by the assessee as an employer towards the setting up or formation of or as a contribution to any fund, trust, company, AOP, BOI, society registered under the Society Registration Act or other institution for any purpose except where such sum is so paid for the purposes and to the extent provided under 3614. What does this mean? Yes. So 40A9 here means that if any sum is paid to an unrecognized provident fund, so employer contribution to the recognized provident fund is allowed. Any sum paid to the unrecognized provident fund will not be allowed as the deduction. Are we getting this particular point, students? So any contribution to the unrecognized provident fund will not be allowed as the deduction over here. Clear? So just write it over here. Subject to 40A9. Okay, if it is not recognized provident fund, this will not be allowed because here it says towards a recognized or the approved superannuation fund. Fine. 4A says any sum paid by an assessee as an employer by way of contribution towards the pension scheme as referred to in 80 CCD On account of an employee to the extent it does not exceed 14% of the salary of the employee in the previous year. So this is substituted for earlier 10 for 14. So 3614A is contribution or the employer contribution to the pension fund under section 80 CCD, right? Referred to in 80 CCD, restricted to 14% of the salary. What is the salary here? Salary includes the basic salary and the dearness allowance. So this is basically basic plus the DA. So this will be restricted to the 14% of the salary of the employee. This employer contribution will be restricted to that. Are we clear? Now, is this also subject to 43B? Let us look at it, whether 43B talks about this. Any sum payable by the employer by way of contribution to any superannuation fund, gratuity fund or provident fund which is there. It is not talking about the pension fund student. So this is not subject to 43P. Are we getting it? This is only providing for the restriction of 14%. This is only providing for the restriction of 14%, which is given under 80 CCD also. If you see, this is 14%, right? Where the contribution is made by the central government or the state government, the employee contribution is allowed as deduction. And 10% if the contribution is made by any other employer. And if you opt for 115 BAC 1, then in that particular case, it will be 14%. So under 80 CCD 2, it is allowed as a deduction in the hands of the employee also, which is the employee contribution. Are we clear? So this is not subject to 43B. It is not covered in other fund for the welfare of employee. No, this is a separate fund. This is a pension fund which is referred to in 80 CCD. Are we clear? So this is basically allowing us a restriction which is there, restriction to the extent of 14%. Clear? Any question, any doubt? Yes. So 3614A provides the restriction of up to 14%. However, if you provide the contribution to any unrecognized provident fund, then it will not be allowed as the deduction. Clear? Any questions, any doubt? Okay, the excess will be disallowed over here. Fine. Let us move further then. Any sum paid by an assessee as an employer by way of contribution towards an approved gratuity fund created by him for the exclusive benefit of an employee under the irrevocable trust. So this is the contribution to the approved gratuity fund. Now, contribution to the approved gratuity fund is obviously allowed as deduction, but this shall be also subject to section 43B. So this is subject to 43B. So allowed if deposited before the due date under section 139(1). And this is also subject to 40A9, which is unrecognized gratuity fund. This will be disallowed. There is one more section under 40A. Let us look at it. (40A7), which says that subject to the provisions of clause B, no deduction shall be allowed in respect of any provision made by the assessee for the payment of gratuity to his employees on their retirement or on termination of their employment for any reason. However, nothing in this clause A shall apply in relation to any provision made by the assessee for the purpose of payment of a sum by way of contribution to the approved gratuity fund, or for the purposes of the payment of any gratuity that has become payable during the previous year. So what does 40A7 says? This is also subject to 40A7. Which is provision for gratuity is disallowed. So if you remember, we had said that any kind of provisions will not be allowed as deduction, right? So provision for gratuity is specifically disallowed under 40A7. If you make the actual payment, only then it will be allowed. But if you make a provision, it will not be allowed. If you make a provision that is going to be payable in that year, that's fine. But if you make a provision that on termination, I will have that much liability, if let's say 10 employees will get terminated or 10 employees will get retired in 2030, that kind of provision will be disallowed under 40A7. Is this clear, students? Yes or no?
मैम प्रोविजन क्रिएट करके अगर बिफोर ड्यू डेट पेमेंट कर देंगे तो अलाउ रहेगा ना मैम?
हाँ, अगर आप वही साल में पेमेंट कर रहे हो, then there is no problem. But if you are making a provision for termination, then in that case, this will not be allowed. Fine?
Okay, ma'am. Yes.
Now here I would like to discuss one case of Shasun drugs. This is Shasun chemicals and drugs. A Supreme Court ruling. In which case, what had happened? In that case, the payment of bonus was made by which is bonus to the employees, was paid to a trust. Okay, the payment of bonus was paid to a trust. This was paid to a trust. This was not directly paid to the employees, and the trust paid to the employees in that case, right? But this amount which was paid to the trust, and then the trust paid to the employees before the due date under 139(1). Okay, so in this case, the question was whether assessee itself did not pay to the employees, it paid to a trust, but trust paid it before the due date of 139(1). Whether this will be allowed under 36(1)(2), subject to section 43B. So the Supreme Court in that case said that since the bonus was ultimately paid to the employees before the due date of 139(1), therefore this is allowable as deduction. And this is not a contribution to any unrecognized trust which is there. So the employer has created a separate trust just for the purpose of making it efficient to make the bonuses to employees. This is not something an unrecognized contribution. This is not an unrecognized fund. So this will be allowed if ultimately paid to employees before the due date under section 139(1). So here 43B is satisfied. Clear? Fine. Okay. Let's proceed further then again under 36. Next is any sum received by the assessee from any of his employees to which the provisions of 22410 apply. If such sum is credited by the assessee to the employee's account in the relevant fund or funds on or before the due date. What is it they are talking about? Yes. Employee contribution to PF. Yes, Geet, you're correct. So, 3615 talks about the employee contribution to the PF. It is not employer, it is employee contribution to PF. So 22410. What is 22410? What is 22410? Yes, 224 is definition of income. Income includes any sum received by the assessee from his employees as contribution to PF, superannuation fund or any other fund set up under the ESIC. Right? So, employee contribution to the PF is considered as the income of the employer. This is considered income of employer under section 22410. This is employer contribution to PF or SAF or the ESIC. However, this is allowed as a deduction under section 3615. So this is first considered as the income of the employer. Then 3615 is saying that I will allow you as the deduction the employee contribution to the PF under 3615 if it is, so 3615A, if it is credited by the employer in the employee's account on or before the due date. This is 3615A. Right? So if it is credited to the account before the due date. Now what does the due date here means? Due date here means, due date here for the purposes of this particular clause, due date means the date by which the assessee is required as an employer to credit an employee's contribution to the employee's account under the particular act which is there. So here the due date doesn't mean the due date of return of income. Students, here due date does not mean the due date of return of income. Here the due date which is there is the due date of the fund. It is not the due date of the return of income. Beware about this mistake that you may make in the examination. Right? So here the due date is the due date of the particular fund which is there. This is not the due date of the income tax return. Do not make this mistake in the examination. What is the due date of fund?
15 days from the end of the month.
Correct. 15 days from the end of the month. So in this particular case, the due date which will be there will be 15 days from the end of the month, which is the due date of the fund. So basically in the examination, you will make this kind of presentation. So whenever you get the employee's contribution in the examination, you will first consider the employee's contribution to PF as the income under section 22410. This will be added, right? Then less deduction under section 3615A if deposited before the due date of fund. So then only you will reduce. So nil will be the answer. If you don't deposit within the due date of the fund, even if you have deposited before the due date of filing of return of income, you will not get the deduction. Fine. So here section 43B is not applicable. 43B here is not applicable. Are we clear, students? Fine. So this is very, very important. Do not make a mistake in the examination. Clear? Okay. Let's proceed further. So we are done with 5A. Here the explanation is also specifically now providing for the removal of doubts. It is hereby clarified that the provisions of 43B shall not apply for the purpose of determining the due date under this clause. Because in the past, many Supreme Court many judgments had held that the due date here can also be meant as due date of filing the return of income. So here 43B is only applicable for the employer's contribution. For the employee's contribution, the due date will not be considered. Clear? Yes or no? Any doubt? Any question? Fine.
तो मैम आफ्टर ड्यू डेट भी पेमेंट कर दिए तो अलाउ नहीं रहेगा ना मैडम फिर?
नहीं रहेगा. So here explanation 5 is also there to 43B, which says that for the removal of doubt, it is hereby clarified that the provisions of 43B shall not apply to the sum received by the assessee from any of his employees to which the provisions of 22410 applies. So basically 43B is not applicable as per the explanation to section 3615A and section 43B. Are we clear? Okay, next move further. In respect of animals which have been used for the purposes of the business or profession, otherwise then as stock in trade, and have died or become permanently useless for such purpose, the difference between the actual cost to the assessee of the animals and the amount, if any, realized in respect of the carcasses or animals. So basically, this is, I'll put it in the others. 3616 deduction for animals died, which is the actual cost minus amount recovered, other than treated as stock. Right? This is self-explanatory. I'm not getting into further details of this. Subject to the provisions of subsection 2, the amount of any bad debt or part thereof which is written off as irrecoverable in the accounts of the assessee for the previous year. So I'm writing this in the finance 3617 bad debts. Right? Bad debts is allowed as deduction, provided that in the case of an assessee to which 7A applies. We'll see what is 7A. So for now, I'm not going into this particular clause. Okay. Now this is saying subject to the provisions of subsection 2. What is subsection 2? 36(2). In making any deduction for a bad debt or part thereof, the following provisions shall apply. No such deduction shall be allowed unless the debt or part thereof has been taken into account in computing the income of the assessee of the previous year in which the amount of such debt or part thereof is written off, or an earlier previous year, or represents the money lent in the ordinary course of the business of banking or money lending which is carried on by the assessee. So bad debts are allowed on the basis of following condition. What are the conditions? What are the conditions for allowability? That the income which is there, the income should have been considered in any previous year. Right? So the deduction will not be allowed unless the debt has been taken into account in the computing the income. So income, or we can write like this, that was considered as income in earlier previous year. So unless and until you have charged the income to tax, how can I allow you the deduction of the bad debts? Right? So the debt should have been considered as income. That is the very, very first point. Secondly, what does 36(2) says? If the amount is ultimately recovered by the, or if the amount ultimately recovered on such debt or part of the debt is less than the difference between the debt and the amount so deducted, the deficiency shall be deductible in the previous year in which the ultimate recovery is made. Now, what does this mean? So, in case, let's say, for example, the assessee has the bad debts, right? And later on, there is this recovery of the bad debts. Assessee had the bad debts, and there is later on the recovery of the bad debt. So, let's write it over here. Recovery of the bad debts. So, first I have allowed the bad debts and then I get the recovery. So, the bad debts deducted, or rather I will write like this, the bad debts disallowed is, let's say, less than the or greater than the amount recovered. Let's say the bad debts which are disallowed are greater than the amount recovered. So let us take an example over here. let's say total bad debts claimed were 75,000. Let's say total bad debts claimed were 75,000. And let's say the amount allowed by the AO is only 40,000. So let's say bad debt claimed is 75,000. Allowed by AO is 40,000. Right? So how much is the disallowed amount? 35,000. Right? Now let's say the amount or 25,000. Now let's say the amount recovered is 22,000. So let's say the bad debts disallowed is 25,000 and my amount recovered is 22,000. Right? So I had disallowed 25,000 as AO and recovery is only 22,000. So what will happen is this deficiency of 3,000 will be allowed as the deduction under section 36(2). So earlier the AO had disallowed it, considering that this is not really the bad debt. Right? So then the balance will be okay, this is 35 only, sorry. Or let's make it now this to 65. I will have to change otherwise all the figures. This is, let's say, 65. Right? So the AO initially disallowed me the amount. Now I have actually not recovered. So that's what this section says. If the amount ultimately recovered on such debt is less than the difference between the amount or between the debt so deducted. What was the debt so deducted? 40,000. And the amount recovered is what? Amount recovered is only 22,000. So the debt which was allowed to be deducted was only 40,000, right? And the bad debts actually recovered is 22,000, right? So the balance amount which is disallowed. Now the amount, the difference between the bad debt so deducted, the deficiency will be allowed in the year in which the ultimate recovery is made. If the amount ultimately recovered is less than the difference between the debt which was there, the debt which I had claimed, and the amount which was actually deducted. Right? So the deficiency which is there will be allowed in the year in which recovery is ultimately being made. Is this clear, students? Any question? Right? Any doubt? Any questions? Any doubt?
Clear, ma'am.
Okay. So this is about 36(2). Now, what will happen if the amount of recovery is more than the amount which was the difference between the amount which is basically allowed and the bad debt that you had claimed? In that case, what will happen?
It will be taxable.
It will be taxable. Under which section?
41
36.
deemed income.
Correct. 41 deemed income. Right? So let us go to 41 deemed income. So if let's say for example, now my amount recovered is greater than the bad debt disallowed. This is the second situation which is there. So my amount recovered is greater than the bad debt disallowed. So what is my bad debt disallowed? 25,000. Let's say I have recovered 44,000. So this was 25,000. Let's say I have recovered 44,000. Now the difference between the two. So what is the bad debt actually after recovery? What is the bad debt actually after recovery? This is
21,000.
yes. So this is bad debt after recovery is equal to 65 minus 44. Right? This is 21,000. What is actually being disallowed to me, or what is actually allowed to me? 40,000 was allowed to me. Right? So 40,000 was allowed to me by the AO. So means that there was the excess bad debt allowed, right? So bad debt allowed was 40,000. So therefore the excess bad debt allowed is what? 40 minus 21. This comes to how much?
19K.
19K, right? So we will now look at 41 section, which is our deemed income. What does 41 says? Profits chargeable to tax. It says 41(4), where a deduction has been allowed in respect of bad debt or part of the debt under 36(1)(7). Then, if the amount subsequently recovered on any such debt is greater than the difference between the debt or the part of debt in the amount so allowed, the excess shall be deemed to be the PGBP and chargeable in the tax of the year in which it is recovered, whether the business is in existence or not in that year. Are we clear? So let's just write it. This will be my deemed income under section 41. Are we clear? Any questions, any doubts so far? Bad debt recovery will be the income also in the current previous year. Yes, in which the amount is recovered. Fine. Any questions, any doubt?
मैम डीम्ड इनकम अंडर सेक्शन 41(4) मैम आपने 41(2) लिखा है।
हाँ, sorry, 41(4). This is 41(4). Okay. Fine. Shall we move further? Okay. Now, 36(1)(7), there is one more point. It says provided further that where the amount of such debt or part thereof has been taken into account in computing the income of the assessee of the previous year, in which the amount of such debt or part thereof becomes irrecoverable or of an earlier previous year on the basis of ICDS under 145(2), without recording the same in the accounts, then such debt or part thereof shall be allowed in the previous year in which the debt becomes irrecoverable, and it shall be deemed that such debt has been written off as irrecoverable in the accounts for the purposes of this clause. Now, what does this mean? See, as we know that ICDS considers the income, right? Now, this income may not be recorded in books of accounts because that may not be income as per the books of accounts. But for the purposes of ICDS, this is income. So, if it is considered as an income under ICDS and not considered as income in the books of accounts, and subsequently there is the bad debts which is happening, it shall be allowed as the deduction, irrespective of the fact that in the books of accounts this is not allowed as the this is not considered as the income. So if income is considered as per ICDS but not considered in the books of accounts and the debt becomes irrecoverable, still the deduction of bad debts will be allowed. Fine. So let's just write it here. If income is considered as per ICDS and not books of accounts, still bad debts allowed. Okay, fine.
मैम लास्ट पॉइंट एक बार फिर से एक्सप्लेन करिए.
Yes. So the point is कि अगर हमने ICDS के हिसाब से we have considered the income, but books of accounts में income is not considered. Quite possible ICDS regards differently the income as compared to books. Books में for example subsidies हम नहीं recognize कर रहे as per AS which is there. ICDS में we recognize the subsidies when the collection happens, right? Now if there is, let's say, a bad debt which happens, so even if the income is not recognized in the books, still we will allow the deduction of the bad debts because it was recognized as per ICDS. Because what is the condition for claiming the deduction of bad debt? That the debt should have been considered as income in the earlier previous year. Are we clear now?
Clear, ma'am.
Okay. Now, provision for doubtful debts is not allowed as deduction. Bad debts, actual bad debts are allowed as the deduction. Provision for the doubtful debts are not allowed. But in one case, the provision for the doubtful debts are allowed, which is as per 3617A. What does it say? In respect of any provision for bad and doubtful debts, in these cases will be allowed as the deduction by a scheduled bank, not being the one which is incorporated outside India, or a non-scheduled bank, right? Or a cooperative bank other than primary agricultural society or primary cooperative agricultural and rural development bank, an amount not exceeding 8.5% of the total income. An amount not exceeding 10% of the average advances made by the rural branches of such bank computed in the prescribed manner. So here we can write that 3617A provision for doubtful debts. So this is allowed to the scheduled or non-scheduled or cooperative bank, which is allowed to the extent of 8.5% of the total income. And if they have rural branches, then this is 10% of the advances made by the branches. Average advances. Right? Then this scheduled bank or non-scheduled bank will get an option to be allowed in any of the relevant assessment year the deduction in respect of provisions made by it for any assets classified by the Reserve Bank of India as the doubtful assets or loss assets in accordance with the guidelines issued by the RBI for an amount not exceeding 5% of the such assets in the books of accounts of the bank as on the last day of previous year. So basically what it means is that in case of NPAs, non-performing asset, which are classified as doubtful or loss asset by the RBI or in accordance with the RBI guidelines, right? In accordance with the RBI guidelines, you have to classify this. So in that case, 5% additional is allowed, 5% of the such asset. is allowed as the deduction. Are we clear? Any question, any doubt? Okay. Then a bank which is incorporated outside India, for that 5% of the total income is there. So a foreign bank, in that case, the deduction will be 5% of the total income. A public financial institution or state financial corporation or state industrial investment corporation, again, they have the limit of 5% of the total income. So, a PFI or the SFI, they also have the limit of 5% of the total income. They don't have any deduction for rural advances. A non-banking financial company, for that also it is 5% of the total income. Fine. So this is the provision for doubtful debt which are allowed. Any question, any doubt till now? Okay. Now, what does 36(1)(7) is saying? It is saying that in case of assessee to which 7A applies, the deduction of the bad debt will be allowed, will be limited to the amount by which the bad debt exceeds the credit balance in the provision for doubtful debt account. So basically, in case of these assessees, in case of these banks, if there are actual bad debts which are arising, in case there are actual bad debts which are arising, then first it has to be adjusted against the provision for doubtful debt balance, and the balance will be claimed under 36(1)(7). Are we clear? Is this clear, students? So just write it. In case of actual bad debts, first adjust against provision for doubtful debt credit balance, excess over that allowed as deduction under 36(1). This is normal accounting, right? Like first, because you have already claimed a deduction of 36(1)(7)(a), so first you will adjust against that because there is a credit balance of that and you have already claimed that as deduction, and any excess over and above bad debts which are actually happening, you will claim the deduction of that under 36(1)(7). Is this clear? Any questions, any doubt? Yes or no?
Clear, ma'am.
Fine. Okay. Next is 36(1)(8). In respect of any special reserve created and maintained by a specified entity, an amount not exceeding 20% of the profits derived from eligible business computed under the head PGBP. So let us write down. This is next section 36(1)(8). Deduction for special reserve. Deduction for the special reserve created by the specified entity. What are the specified entity? Specified entity means a financial corporation which is a public sector company, banking company, cooperative bank other than the primary agricultural credit society or primary cooperative agricultural and rural development bank, housing finance company, other financial corporation including a public company, right? which is engaged in the eligible business, which is deriving the profit from eligible business. What is the eligible business? For a financial company which is there, or for the banks which are there, or for a cooperative bank which are there, the business of long-term finance for industrial agricultural development, development of infra facility, and development of housing. For the housing finance company, the profits from the providing the long-term finance for construction or purchase of houses in India for residential purpose. And for the any other financial corporation, the business of providing long-term finance for development of infra. So if these are deriving the profits from these businesses, then they have to basically, under their statute, they have to transfer the amount to some special reserve. So the amount transferred to these special reserves which are there, the amount up to 20% of the profit is allowed as the deduction under 36(1). Very simple, right? So just write it over here. Who is the eligible assessee? And here I am writing eligible business, right? So eligible assessee is first financial corporation, or public sector which is a public sector company or any other company, bank, cooperative bank, right? These are engaged in the business of providing long-term finance for industrial or agri development, next development of infra facility, or development of housing. Then the housing finance company for the long-term finance for the development, construction or purchase of house in India for residential purpose. Residential houses. And any other company. Any other financial corporation for the long-term finance of infrastructure development. What is the deduction for special reserve which is allowed? Up to 20% of profit from the eligible business. Right? So up to 20% of the profit from the eligible business, this particular amount is allowed as the deduction. Right? However, yeah. So, however, here what is the restriction which is given here is, what they say is that this 20% which is there, it shall be lower of 20% or the amount actually paid into that reserve, or the twice the amount of paid up share capital and the general reserve. So it is not straightforward 20%. So deduction here will be, or we can write like this way. Deduction shall be lower of 20% of profits from eligible business twice the paid up share capital plus general reserve amount transferred to the special reserve. Right? So it says that in respect of the special reserve created, an amount not exceeding 20% of the profit. So basically amount actually transferred or 20% of the profit or the aggregate of the amount which is carried to the reserve, which is basically twice the amount of paid up share capital on the general reserve. So lower of the three will be allowed as deduction under 36(1)(a). Is this clear, students? Yes or no?
Clear, ma'am.
Okay. Next one is 36(1)(9), which is expenditure bona fide incurred by the company for the purpose of promoting the family planning amongst its employees. So again, this is employment related. So I'll put it here. Very simple. 36(1)(9) for the family planning for the employees. Right? Provided that where the expenditure is of a capital nature, 1/5 of such expenditure shall be deducted in the year of incurrence and the balance in the equal installment for each of the 4 immediately succeeding previous years. So, if it is capex, then 1/5 over 5 years. Right? Provided further, the provisions of 32(2) and of subsection 2 of 72 shall apply in relation to deductions allowable under this clause as they apply in relation to deductions allowable in respect of the depreciation. What does this mean, students? Yes.
Depreciation on that capital asset is allowed.
No, it doesn't mean like that. It says if any deduction is not absorbed, so it will be carried forward like the unabsorbed depreciation. 32(2) was what? Unabsorbed depreciation. 32(2) was unabsorbed depreciation. So any deduction which is of this capital expense, which is not allowed to be set off, right? Or even the family planning expense which is there, if it is not allowed to be set off because the profits are lesser than the expenditure, then it will be adjusted like the unabsorbed depreciation. That's what this section is trying to say. Are we clear? Yes or no? So let's just write it over here. Unabsorbed expense treated like unabsorbed depreciation. Clear?
Clear, ma'am.
Okay. So this is very, very important. Right? That this 32(2) is basically like our unabsorbed depreciation. Okay. So if let's say for example we are not able to utilize it, then we can carry it forward in the next assessment year and that will be treated like the hierarchy will be the same. First you will absorb the profits, business losses, and then you will set off any unabsorbed expenditure which is there. Clear? Then it is saying that if you look at the next proviso, it says provided further that the provisions of this 35(5), 35(2), 41(3), 43(1) shall so far as may be apply in relation to an asset representing the expenditure of a capital nature for the purpose of promoting family planning as they apply in relation to asset representing expenditure of capital nature on scientific research. What does this mean is, so 41(3), if you see, it is regarding that if the asset which is there is sold and the amount of recovery from that sale of asset is more than the amount of deduction allowed. So basically, if the family planning in relation to that, they have created some capital expenditure and there is some asset which is created in that. So if that asset gets sold off and the amount of sale price of that asset is more than the deduction which is allowed, which is 1/5 every year. So then the excess will be considered as the deemed income under 41. Fine. Okay. So this is done. Then we have 41.12. Any expenditure not capex incurred by a corporation or body corporate if it is constituted or established by central, state or provisional act. Such corporation having regard to the objects and purposes of the act is notified by the central government. The expenditure is incurred for the object and purpose authorized by the act under which it is constituted. So that will be allowed as deduction. I'm not writing about it. Very simple regarding the central state corporation. Any amount of banking cash transaction tax paid by the assessee on the taxable banking transaction entered into by him is allowed as the deduction. So let's just write this one. Any BCT is allowed as deduction under section 36(1)(30). Any amount sum paid by the public financial institution by way of contribution to credit guarantee trust for small industry is allowed as deduction. Any amount equal to the security transaction tax paid by the assessee in respect of the taxable security transaction entered into the course of business during the previous year, if the income arising from such taxable security transaction is included under the PGBP. So STT is allowed as the deduction under 36(1)(15). This is in contrast to capital gain. So if this is chargeable under PGBP, this will be allowed. If under capital gain, this will be disallowed. Right? Under capital gain, security transaction tax is not allowed as the deduction. Right? Any amount equal to the commodity transaction tax. If the income from the commodities is computed in the PGBP. Right? So even commodity transaction tax, banking cash transaction tax, STT are all allowed as the deduction. Any amount of expenditure incurred by a cooperative society engaged in the business of manufacture of sugar for purchase of sugar cane at a price which is equal to or less than fixed or approved by the government is allowed as deduction. Mark to market loss or other expected loss as computed in accordance with the ICDS is allowed as deduction. So if you remember, we just now dealt that ICDS, if the amount is on the monetary asset, if the foreign exchange gain or loss is in respect of the monetary item, ICDS 6 says mark to market gains or losses shall be allowed, and 36 confirms this. Right, as per section 36(1)(18). Are we clear? Any questions, any doubt? Yes. So this completes your section 36, students. Yes, any questions, any doubt? Yes or no? Okay. Now we'll extend a little bit so that we discuss about the 37 also, right? So we'll discuss about 37 and then we will stop for the class today. Okay. So we are not going to end the lecture over here. We are going to discuss a little bit more and then we will stop. So 37 is fairly simple. Let us just look at section 37. Because in the next class, which is going to be the last class for PGBP, we have too many other things to do as well. So 37 is the general deduction. It says any expenditure not being of the nature described in 30 to 36, because 30 to 36 is specifically providing for certain expenses. It is general, like what is not covered specifically under 30 to 36, and not being in the nature of capital expenditure or personal expenses of the assessee. So 37 talks about what? General deduction, right? So it talks about expense not covered under 30 to 36. Not capital expense. Not personal expense. Right? Laid out or expended wholly and exclusively for the purpose of business or profession. Wholly and exclusively for business or profession shall be allowed as deduction under PGBP. Alright? Now, what is not allowed here? It is hereby declared that any expenditure incurred by the assessee for any purpose which is an offence or which is prohibited by law shall not be deemed to have been incurred for the purpose of business or profession. So, any expense prohibited by law or which is an offence this is disallowed. Right? So any kind of penalties, any kind of compounding fees where you compound the offense, where instead of prosecution, you choose to pay the fine. Those kind of expenditure will not be allowed as the deduction. So any expense which is prohibited by law is not going to be allowed as the deduction. Any kind of penalties will not be allowed as the deduction. Fine. Now it says for the purpose of the removal of the doubt, it is hereby declared that the expenditure incurred by the assessee for any purpose which is offence or which is prohibited by law shall include the following expenditure incurred by the assessee. For any purpose which is an offence under or which is prohibited by any law for the time being in force, whether in India or outside India, to provide any benefit or perquisite to any person, whether or not carrying on a business or exercising a profession, and acceptance of such benefit or perquisite is in violation of any law or regulation for the time being in force governing the conduct of such person. To compound an offence under any law for the time being in force within India or outside India, or to settle any proceedings initiated in relation to contravention under this law. Now, what does this mean? Let us look at it one by one. So, first of all, any kind of expenditure, which is it saying, which is prohibited under the law is not allowed. So, any kind of expenditure that they say that, in any law, whether within India, whether outside India, any expenditure which is not allowable, that shall not be allowed as the deduction. Remember that. Right? So any expense which is not allowed will not be allowed as, like under any law it is not allowable, it is not allowed as deduction. Secondly, any expense to provide any benefit or perquisite. So let's just write it here. So this offense can be within India or outside. Not only offenses committed in India but outside. Now this entire term means or includes expense for providing any benefit. expense for providing any benefit or perquisite to a person which is in violation of the code of conduct governing that person. Now, the classic example of this or why this was introduced was where the pharma companies give freebies to the doctors, right? This is prohibited under the, for the doctors, this is prohibited for them under the medical council regulations, right? So doctors cannot accept the freebies, free medical kits or medicines from the pharma companies. Otherwise, what they will do is they will try to suggest to their patients that you use or consume only these medicines. Now, this will obviously, be kind of, damaging the patients also, causing harm because they are getting this for free and they are getting this incentive to promote their medicines of a particular pharma company, which may not be correct. So this is prohibited under the Indian Medical Council regulation. So if pharma companies give these freebies to the doctors, then for the pharma companies, this will not be allowed as the deduction because this is for providing any benefit or perquisite to the doctors, which is against the code of conduct of the Medical Council regulation, and this will not be allowed. Now, if you remember, we had done this in the 28 also, right? So in the hands of the pharma company, I told you there will not be deduction of expense under 37 as per the explanation which is there. Sorry. As per explanation 3 to section 37. Right? And in the hands of the doctors or in the hands of hospital, this will be taxable under 28(4) and there will be TDS under 194R. Is this clear, students? Yes?
Here, ma'am.
Okay. Then this also includes compounding of offense. So any expense for the compounding of offense means to pay the fine instead of prosecution, whether in India or outside. This is going to be disallowed. And last, to settle proceedings in relation to contravention as may be notified. So any settlement amount that you pay, that is not allowed. What are the notified law? So they have notified central government by this notification of 23rd April has notified following laws, which is under the SEBI, SCRA, Depository Act or Competition Act. Under these laws, if you make any settlement proceedings, it will be disallowed. Right? Last one point. For the removal of doubts, it is hereby clarified any expenditure incurred by the assessee on the activities relating to the CSR shall be deemed not to be an expenditure incurred for the purpose of business or profession. So basically, CSR expense is also not allowed. This is going to be disallowed. Further, any expenditure incurred by the assessee on advertisement in any souvenir, brochure, tract, pamphlet published by political party is not allowed. So 37(2)(b) says expenditure for advertisement for political party. This is disallowed under section 37(2)(b). But there is one more effect of this. What is the effect? Can anybody tell me? Yes. There is one more impact of this. ATGG. Yes. ATGGC and ATGGB. Right? Yes or no? Chapter 6A deduction. In computing the total income of the Indian company, any sum paid by it to any political party or electoral trust is allowed under as the donation which is allowed under ATGGB. Under ATGGC, any in the computing the total income of the assessee, any contribution made to a political party or electoral trust shall be allowed under ATGGC. Right? So any direct contributions to the political parties will be allowed as the deduction under these particular section of ATGGB, ATGGC. Yes or no? Is this clear, students? So this will be
Clear, ma'am.
allowed as the deduction under ATGGB for the company or ATGGC for the others, but it should be other than in cash. This should be other than in cash, right? This is what they say. Sorry. ATGGB, ATGGC both says that it has to be other than in cash. Are we clear? Any questions, any doubts so far? Okay. So what your interest on income tax, interest on TDS will not be allowed. You can just write it few examples. TDS, income tax, this is not allowed. Interest on GST, this is allowed, right? Then penalties, these are not allowed. Legal fees, yes, these will be allowed. These are not for offense. Then, as I told you, personal expenditures are not allowed. But in case it is expenditure for travel of wife of director accompanying him to conference, this is not a personal expenditure, so it will be allowed. Because this is a customary practice for the spouses to accompany the directors, so it will be allowed. If it is for the holidays, it will not be allowed for sure. Ankit, whether foreign bank can avail the deduction of NPA of 5%? No, it can't. Only in respect of the normal doubtful debts, it can. Sorry, not normal doubtful debts, for that advances which is given for the 5%, only for that, not for NPAs. Is this clear, students? Okay.
Yes, ma'am. Clear.
Okay. Now what we are left with is section 40. Entire section 40 is there. We will be doing that in the next class. 48.2 we have already done. 48.3 we will do in the next class. 43B also somewhat we have already done. So in the next class, we will start with the sectoral deductions also, and we will complete the entire PGBP chapter as well. Fine. So I would want you to please revise and come in the next class. Next class, we are going to discuss about the sectoral based deduction for different sectors. We are going to finish these balance which are there, and then we will complete this entire topic. Fine. So that's all for today. Thank you so much. We'll meet in the next class.
Thank you, ma'am.
Thank you.
Thank you, ma'am.
Yes.
Recording stopped.